Hello, and welcome to The Pitch. I'm Huntsley of Livewire Markets. Even if you're an Australian investor watching this video, I'm willing to bet you've heard of Costco, the massive American retailer that makes even the largest Woolworths and Coles stores look like candy bars. But it's also true that Costco is too big and arguably too well known for many investors. So is there another retailer that has what it takes to go the distance and maybe become the next Costco? Joining me to discuss is Jack McManus of Canopy Investors. Welcome, Jack. Good to have you with us.
Thanks for having me.
So, Costco's share price, I didn't know this until I saw this actually. Costco's share price has soared more than 17,000% since listing in 1984. It's been a tremendous success story. But have you found another low-cost retailer that's on the rise? And what do you like about it?
Yeah, look, so Costco, it's one of the all-time great retailers, one of the all-time great businesses. And we're excited about Dollarama. So it's a large position in our fund. But it's important to know that they're following a different path to success. So, as you said, Costco, it's like a destination shop. They have these huge warehouses. You need a membership card just to get in the door. And then when you get there, you're going to go in, you're going to stock up. You're going to get 48 rolls of toilet paper. You're going to get a flat screen TV and a slice of pizza, all at a bargain price.
Are you speaking from experience, Jack?
I mean, I've just moved to Brisbane, so I've got a lot more storage.
Fair enough.
But Dollarama, it's more of your convenience shop. So if you think about it, they're smaller stores, they're more accessible. So 85% of the Canadian population lives within 10 Ks of a Dollarama store. And when you go there, you might buy 2 rolls of toilet paper and a bunch of household essentials, all priced at $5 or less. So they're different business models, but there are some sort of core key strengths that we think make them both pretty special. So firstly, they're both obsessed with delivering value to the customers. So Costco does this by leveraging a huge buying power across a limited selection of items, and it passes those savings on to the customers. Dollarama does it by sourcing most of its products directly from suppliers, and it leans very heavily into home brands or private label. So private label represents about 70% of their sales versus 30% they might see at Woolies or Coles, and that allows them to offer prices well below their competitors, even Walmart. Secondly, they're both exceptional operators. So Costco is famous for relentlessly optimizing every part of their operations, and Dollarama, they're also very lean, very disciplined. They've delivered very consistently over the last decade. And thirdly, they both have really strong brands. So you might not have heard of Dollarama, but they're actually the highest rated retail brand in Canada. And their value proposition is really about a mix of convenience and value.
I'm heading to Canada soon personally. I will have to look out for a Dollarama if I see one. There is an Australian link to this story, incidentally, everybody. Dollarama actually approached the Reject Shop, which is obviously an ASX-listed low-cost retailer you might have seen in your local mall. They approached them back in 2023. So can you take us through that story?
Yeah, look, reportedly there were some talks that were going on in 2023. And as you said, it didn't eventuate in a transaction. And look, we don't have the inside scoop on this.
Sure.
And the company is, they are quite discreet. They hold their cards very close to their chest. If I had to speculate, the Reject Shop's been through a challenging period for a while now. The share price is depressed, so it's likely Dollarama has just been a little opportunistic. Nothing eventuated, and we're actually quite happy about that. We'd prefer that Dollarama focused on more promising geographies.
Yeah, well, I was about to say, is it a good thing that they keep their cards close to their chest? I know investors always talk about wanting to hear more communications from management and things like that.
Yeah, it's a double-edged sword. If you've ever listened to one of their earnings calls, they keep their answers short and sweet. And so, sometimes as an investor, you want more information, but we also understand, they've got a secret sauce that they're trying to keep as a competitive advantage. So I think it's good that they are quite discreet.
Okay, fair enough. So with that said, then obviously we just talked through the Reject Shop story. Do you think there are other M&A opportunities on the horizon for Dollarama?
Yeah, there's some interesting opportunities out there, and they have a rock solid balance sheet, so they clearly have the financial capacity to do things if they want to. But their track record suggests they're going to be super selective. So I think what they've done with Dollarcity in Latin America is a good example of the thing they might do. So that started as a commercial agreement in 2013. So they didn't actually own any of the company, but they worked alongside the company, got to know the markets, and it took them 6 years to pull the trigger and buy just over half of that company in 2019. That's been a success, and they've since increased their equity holding in that to 60% just this year. So that's the sort of thing we'd like to see, very measured approach, very selective and very disciplined.
But what's the biggest risk to the company?
Okay, so there's probably 3 risks that we are focused on. First risk is really around price increases and the value perception of the brand. So the company over time have introduced higher priced products into its offering. So if you think maybe a decade ago, the highest priced product in the store might have been $2. It's then been $3, $4, and today we're at $5. That's been a good thing because it's allowed them to introduce new products into their offering, which has actually broadened the appeal of the brand to a larger consumer base, and it's also driven growth. We think they're going to continue to do that. So, we might see a $6 or $7 introduced, but they just have to be careful not to go too far, too fast and sort of disrupt the value proposition. Secondly, just on competition, retail, it's a competitive space. There's always the risk that someone comes and tries to copy their model or sort of makes it more expensive to roll out stores if they're sort of bidding up real estate. But they have a pretty good head start here. Their store base in Canada is 6 times larger than the nearest competitor. And then finally, just again with retailers, execution risk is always there. So this is just about making sure they're covering the basics, the right stocks in the right place at the right time, that the shelves are full and that they sort of maintain their relationships with suppliers. But again, we're pretty relaxed about that. It's a very hands-on management team. We're told the CEO is in stores 3 days a week, sort of just visiting and making sure that everything's in order. So they're the risks, but we're pretty comfortable that the company is on top of them.
Beautifully explained. Jack, thanks very much for joining us. That's Jack McManus there of Canopy Investors. And thank you for joining us for The Pitch. If you enjoyed that interview, you can subscribe to the Livewire Markets website as well as our YouTube channel, where you can find more episodes of The Pitch. Until we see you next, take care.